Hey guys, welcome back to another Trading Edge video. If you guys are new to the channel, thank you for joining. This is a video I put out each and every week, walking you through the top trading ideas that are on my radar for the week ahead, along with other valuable trading lessons, both on the technical, psychological, business side of trading as well. Now, we've got a lot to look at this week, so you may want to grab a coffee because this could get long. Speaking of grabbing, you also want to make sure you grab a spot at our upcoming 2-day online trading workshop. Spots are getting filled really quickly, and we do close things down after we reach a certain level. So although we're a month away, don't dilly-dally, get on that now before it's gone. All right, let's hop in. So we're going to kick things off here on the pound dollar, and we've got somewhat of an interesting situation. Overall, the market's been in consolidation. We've bounced up, we've bounced down. We're kind of trading right in the middle, so there's no clear directional bias. But if we had to create a recent directional bias, it would be to the upside, with the most recent move being a violation of our previous level of structure right here and a violation of our previous level of structure right there. And by the term violation, what I mean by that is a break and close above. And I followed this 4-step process in my trading, IPDE, identify, predict, decide, execute. And what that is, it's a pretty much like a rules-based flow chart. And if I identify a violation, a higher high, a higher close above a previous level of structure, I then go to the next stage, which is that allows me to predict a continued move higher. Now, what makes this one interesting is because of there being no larger directional bias, the question I want to ask myself is, Akil, if we are likely to go higher, then where are we likely to go higher to? And what, normally I would say, hey, well, our previous structure high right here is the clear spot. But if we pay attention to this most recent, I guess not most recent, but the previous green candle right here, you can see that it has a long wick to the upside, which shows us a sign of rejection. And that long wick to the upside comes right at another level, which also had a long wick to the upside. So a clue that the market respects this level. But the interesting thing about this is when I throw in some volume, which is a tool I use to determine pretty much how much interest there is in the market, there's not really any type of high volume spike, right? You can see right here in the middle is our highest spikes right here with the little dotted line being the point of change, the highest level of volume. Below it is even more volume. Up here, there's not really all too much. So that tells me that there is the chance that price can continue higher, or at least maybe come back to retest this level. So going down to the hourly time frame, here's what I'm looking for. We have had a head and shoulders pattern form. I will draw this out for you. We have our directional move down. We have our brief retracement. We have our extension down. We have our deeper retracement. We have our failed extension down. And then we broke and closed above what's called the neckline. The neckline is going to be pretty much the connect the dot parts. And I guess there are actual dots on this line chart as well. But the connect the dot parts between the highest point of the left neck and the highest point of the right neck, looking something like this. Or it's going to be connect the dots between or a horizontal line, I should say, just between the highest shoulder mark, which is right here. Either way, once we violate that level, that completes the head and shoulders, and then we can predict a move up. Now, there's a few ways of trading the head and shoulders. One is trading it during the breakout. Another way is looking for the retracement, and that's what we're getting right here. And again, we can see that we came to a previous level of structure right here. This is where my expectation would be, but based on what we talked about earlier, it would not surprise me if we could continue higher or at least retest these highs. So if that's going to happen, we need to ask ourselves the question, as price pulls back, where are we likely to terminate? And I like to start with a big zone. I'm like a kid drawing out a picture, right? Start with the perimeter and then fill in the details later. I like to start with a big zone and say, okay, well, this is the kill zone of where price can come to. Now, within that kill zone, where is price likely to come to? And this is where I can take out the rest of my technical tools. So We'll start with a simple and classic pattern formation, AB equals CD pattern, or a one-to-one measured move. And what I'm going to do with that is I'm going to take the length of this first part of the pullback, this swing high to this swing low right there. I'm going to copy and paste it. I was just going to steal it, but I'll just copy and paste it. And I'm going to drag it on to the retracement. And that would give me an equal measured move, an AB equals CD pattern that completes right here. Now, is that enough to trade it? No, right? I mentioned in the previous podcast episode, I had this phase and stage in my trading where I did a lot of dumb things, like trading every double top by itself and lost a lot of money. Something else that I traded by itself, or tried to trade by itself, was the AB equals CD pattern. I learned a very valuable lesson. If I only trade the AB equals CD pattern with no other type of confirmation, I will loseth the money quickly. So don't do that. But when you combine it with other aspects, it could be pretty powerful. So let's start here, right? We have our AB equals CD pattern completion right at this level. What else can we bring in? We can bring in a Fibonacci extension from that same swing, the high of the A to the low of the B and back up. That's going to give me a Fibonacci extension right up here, a 127, right where we're currently at, 1618, a little bit lower. I can bring in a Fibonacci retracement from our most recent swing, this swing low to this swing high right here. You're going to see we get a 618 Fibonacci retracement right around that 1618. So a little bit of confluence there, a little bit of a rejection here too. Just notice that. That's going to be pretty cool. And let's take one more Fibonacci from our ultimate swing low, the head of our head and shoulders, all the way to the top here and see what else we have. You can see we have a 3D too. So if I kind of unclutter this as best as I can, I don't want to take all these fibs off, but you guys can see it, right? We have a nice little zone here where we have an AB equals CD pattern completion. We have our 382 Fibonacci retracement, our 618 Fibonacci retracement, and our 1618 Fibonacci extension, and this little rejection right here as well. So if I wanted to project a point where price may likely reverse at, this is going to be the level. Now, I am not that aggressive just to kind of put a limit order down here and say, hey, if price gets there, buy. You can certainly do that. I like to be predictive in my analysis, reactive in my execution, right? Using an if-then syntax. So if price action comes to that level, then I look for reason for entry. If I get reason for entry, then I enter the trade. And that just gives me a little bit more safety. Real quick, just want to take a look at the RSI, just see if there's anything that's interesting here. I don't think so. So yeah, that's the opportunity here on the pound dollar. Let me just see if there's any volume in there as well while I'm here. For you guys that are new, look at that, yeah. For you guys that are new, I do this analysis live. I mean, I look at the charts and then I record button is on and I try to do it as fresh as possible. That way you get these like reactions of me being actually surprised by stuff. So yeah, that is a big help as well. So yeah, awesome opportunity. Pound, dollar. Again, not awesome opportunity, not a grade A opportunity, but it's a decent opportunity. Next, we're heading over to the euro yen. The yen is going to be a similar situation. And real quick, right? If you are new to the party and you're saying, Akil, why is this really big red candle here on the yen? It's because about a month ago, the yen did something called intervention, which sounds illegal, but technically is illegal as long as they stay within the legal realms and amount of times that they can do it. Anyway, Japan's MOF, the Ministry of Finance, wanted to have a weaker yen. I won't go into details. I looked at that in plenty of videos and podcasts. You can go back and watch those if you want it. But the interesting thing is this. This week, Friday, the actual numbers came out on how much the intervention was, how much they spent on the intervention. And believe it or not, I hope I remember this number correctly, they spent $11.7 trillion on intervention, which is roughly $73 billion US. Don't quote me on that, but somewhere big, right? I guess when you get that much, it doesn't really matter too much. But the interesting thing is this. All of that money spent on intervention and what have these yen pairs been doing? They've been failing massively and they've been slowly and surely, just as we called, working their way up right back to pre-intervention stages. And I got a chuckle out of it this morning because it reminded me of being a parent and how we get the kids to school and the house is a mess because kids are kids and they're throwing stuff everywhere. And then the kids are finally gone. And me and my wife are like, we're going to clean up the house. And we spend all this effort cleaning up the house. And we sit back and we're proud of ourselves like, yeah, look at that. This place actually looks and smells good. And then by the end of the day, after we put the kids to bed and we come back downstairs to get whatever we get before our bed, we notice that the house is trashed again. And all of that effort that we put into cleaning did absolutely nothing. And I used to feel bad about it. But now, at least knowing that I'm not spending $11.7 trillion on doing so, only to have it return to how it was before, it could be worse. Anyway, yen here's what we're looking at. So same concept as the pound dollar. Our most recent move was a break and close above a previous level of structure, right? If we see violation of structure, then we can predict a continuation higher. And the question is, where are we likely to continuate higher to? Now, just with the pound dollar, there's a big zone here. I typically like to start at the lows, right? The most safest conservative point, because that's my trading style, and work all the way to the highs. But again, what is this going to do for you, Akil? This is a zone all the way from 186 even to about 188 even, just 200 pips of room. Well, I want to really break down that zone into a level that I think is going to be the most important level. And if I had to do that, I would say this zone right here is where I would think we can continue higher to 187s. But I'll bring some volume in to confirm that, taking it from our swing high to our swing low and seeing that, well, actually it's a little bit lower, right? So maybe not 187s. This is the brilliance of using volume. It allows me to better pinpoint where in these areas I want to shoot for. I would say our volume starts picking up at about 186 half. So this right here is going to be my target projection, which means this is where I think price is likely to go. So what you can see here is that we're operating in the void. I haven't done that in a while, a little rusty at it, but we're operating between levels of high volume, right? And if you guys are new to volume, volume is synonymous with like interest. The more volume there is, the more interest there is in that level. Supply and demand, support and resistance is basically levels of interest, right? Those levels occur where the market is interested at. So I think of these levels as being like traffic jams where the market has trouble getting past or working through, and these levels being like free back roads or highways early in the morning where no one's there and price can slice through it like a hot knife through butter. There we go. I got it right this time. So anyway, all those analogies aside, I think that price action can go from here to here. That's what you wanted to hear, right? So the answer is, or the question is, I guess, well, how can we take advantage of it? And again, all this nonsense, but we're seriously going through our IPDE. We identified a violation of structure. We predicted a move higher. We predicted if we were to go higher, where that move higher would go to. Now we're deciding how we're likely to get involved. And if we go down to a lower time frame, this is where we're looking for similar things to what we did with the pound dollar. We're looking for that pullback, right? We're looking for a previous level of resistance, which was violated, to now act as support. We're looking for price action to come probably somewhere within this level. And now we're just tracking it. We're tracking this retracement. And like I said before, predictive in our analysis, reactive in our execution. So as price comes down, we're going to look for clues for entry. And then once we get for our reason for entry, boom, nope, arrow, boom, we can look to trade it up. Now I'm just curious real quick, right? This is my line. I wonder if we have, I think it's going to be a little bit higher than a 618. Sorry. Going to a keel brain 161. Oh, wow. Look at that. Right up there. Right up there. Yeah. So what I just did, because I did a horrible job of explaining it, I took my Fibonacci extension tool, and because I'm projecting a potential extension higher, I wanted to note out what extension levels were up there. The main two that I look for are going to be the 127 and the 1618. So I took that Fibonacci extension tool from the swing low to the swing high of my most recent move and back down. And that gave me a 1618 Fibonacci extension level right at the level we were shooting for. If that 1618 Fibonacci extension level sounds familiar, if you guys remember the dollar Canada trade that I showed you guys earlier in this week, Tuesday or Wednesday, yes, that was the exact same extension level that we shot for on that trade. That was the exact same extension level that was hit like a target being shot at by a sniper. Speaking of yen massacres, we are going to head to the New Zealand yen next, which is a pair you rarely see me look at, but this opportunity is massive. So, broken record alert. We're going to go through our 4-step process, IPDE once again. Hopefully you guys are comfortable enough with it now. You can play along and do the analysis with me. But if we identify what is the first thing that we see has happened here on the chart. Yes, we have a break and close above a previous level of structure resistance. After identifying a break and close, we can then predict that price action is likely to go in what direction? Bullish. Well done. Now, the question I want to ask myself is, again, if price is likely to go bullish, then where are we likely to go bullish to? And this is where we're going to need a little bit more detail, right? You can see, well, I guess maybe we don't. We can just zoom out a lot on the daily chart. I'm going to say you can probably pop up to a weekly chart and see that we're a far way away from our next level of structure. Our next high is going to be right back here. Actually, I guess the high technically is going to be right back here at 99 even. We are at about 95 even. So a good 400 pips away. It's another nice head and shoulders pattern, by the way. Sorry, I'm getting distracted, guys. I have trading shiny thing syndrome where I just see stuff all the time. Look at that. Beautiful. Anyway, yes, we can potentially go higher to this level. Once again, we can take out some volume and see kind of what's up there. Not a lot up there. It's not a really good range to pull from, to be honest with you, but we can certainly shoot for a move higher. Now I want to go to the daily real quick and just see if I can kind of pinpoint any place in specific in that zone that I like. I don't like the very extremes. Again, I'm a conservative trader. I think 98 even is a good place to shoot for. So anywhere between 98 and 99 is a pretty decent level to shoot for there. So just like the euro yen, right? We've now have our directional bias. We now know where we can potentially go to. Now we just have to wait for the opportunity to get there. And how is that going to come? Well, I don't know, right? For me personally, I am a pullback trader, so I like waiting for pullbacks, right? If we take a look at our RSI, we can see that price action initially went overbought about right here. And again, overbought means a lot of strength in the market. And then after strength, we tend to get some relief, as we saw kind of right there. Some relief before continuing on our way. Price has now gone overbought again, right at this level. You can see my overbought is at 80 because I look for extremes. I think the default version is 70. So we went extremely overbought here. Just like before, it would not surprise me if we saw a little bit of relief. And as a trend continuation trader, I'm not necessarily trying to buy at the highs. That's a mistake that many newer traders make. Everyone hypes something up. They hear about it. Oh, this is at all-time highs, and they buy it. And as soon as they buy it, whoosh, the market reverses and crashes down. And then the smart traders wait for those dumb traders to panic and get out of their positions and use that as liquidity to get in their new positions. It's a whole thing, right? Anyway, I want to look for these levels of relief. And then as price comes to a cheaper point, as it goes south on me, then look for that next opportunity to buy it up. So I want to be very patient here. Now, something to remember here, and this is going to be key with trend continuation traders. This is our zone, right? So we're expecting price action to continue all the way up to here. Do not panic if you don't if you can't catch the first move. So let's say that price action does something like this, where it comes up, it retraces, and you don't get a reason for entry, you miss it, you're sick, who knows why, and then it goes like that. One of the worst mistakes you can make is panicking and being like, oh my gosh, FOMO, I missed the move, I got to get in right away. And then, like I said before, you get in at the highs and then the market skunks you out, right? Understand that price is most likely going to ebb and flow. We're most likely going to make our way up to this level in some form or fashion of this. And if you go down to a lower time frame, it'll be even more frequent. If you are a pullback trader, right, each of these pullbacks is an opportunity to get involved. So if you don't catch the first one, just wait for the second one. If you don't catch the second one, just wait for the third one. But it's better to just wait for more opportunities than panic and find yourself an opportunity that you don't want to be in. honestly, it's even if you miss for some reason every single opportunity, it's still better that you missed every single opportunity waiting for your rules, because that's process based, versus you got in prematurely and then lost money. Because if you missed all your opportunity, you didn't make money, which, yeah, it's bad, but your account stays where it is. If you rush into an opportunity and you got skunked out of the market, you lost money, so your account is lower. So if you're going to take those two negatives into account, missing out is better than getting in something you shouldn't have been in. And that's how smart traders operate. We just don't make mistakes. We make mistakes. We limit our mistakes. We don't make purposeful mistakes. So let's put it that way. We are human beings, most of us. Now, real quick before I forget, if you like this type of analysis and you like the whole thing where you're following along and playing along and predicting the markets with us, I do recommend that you check out our live trading rooms. We have a London session, we have a New York session. You can join both. If you can't make them live, you can catch the recordings. But we come together each and every day with a group of traders and we walk through the charts together, just like we're doing right here. So if you want reps in the market, if you want an opportunity to learn, an opportunity to ask a lot of questions and really just hang out with other traders, which is kind of rare out there, check out our live trading rooms, www.tier1trading.com. They do come as part of your 14-day risk-free trial, which means you get the rooms, you get some courses, you get the community, all for zero investment. And if you don't like it, then it just cancels at the end of the 14 days and you're done. So check it out, www.tier1trading.com. Love to see you in there. So sticking with our New Zealand theme, we're going to head over to the New Zealand dollar next. And yes, New Zealand is a popular pair this week on the trading edge because it has had a lot of movement. You can see in the chart in front of you, it has had the most movement to end the week. And I didn't do my full research on why this was, but just thinking about what happened throughout the week, there's two things that stand out for me. One is that end of month portfolio balancing that we spoke about in the fundamental video to start the week. And two is that risk on appetite, especially with the ceasefire, non-ceasefire agreement, non-agreement happening with the US. The market has seemed to flock more back to risk on, meaning it's willing to take risk. And again, you get Aussie, you get New Zealand, those type of pairs or currencies seeing benefits of that versus like the dollar, for example. So there could be something else that I missed. I didn't do my research yet. But that's why we're seeing these big booms to end the week on the Kiwi, in my opinion. So in the last New Zealand pair, we looked at a lot of continuation. This one, we're going to look at a potential counter trend trading opportunity. And I know what you're thinking. One, Akil, how can you go from the New Zealand yen and saying massive opportunity to the upside and then go to the New Zealand dollar and saying, hey, look for a counter trend trading opportunity? Well, there are two reasons for that. One, these are two completely different pairs, right? And that's the cool thing about the Forex market. These are individual battles we're dealing with. Yes, they share the same currency in New Zealand, but on this pair, this is the New Zealand dollar versus the US dollar. It is its own game. On the other pair is the New Zealand dollar versus the Japanese yen. That is its own pair. The Japanese yen and the US dollar are not the same, so we shouldn't necessarily expect the New Zealand dollar to react the same off of both of them. Speaking of matches, who do you have this week? I don't know if I'm going to get this out in time. Arsenal, PSG, Spurs, Thunder. This is a great week for sports. I put a poll question up on the YouTube community page. Here's what you guys said so far, but please answer it if you get the chance, if this comes out before those matches start. But anyway, back to the point. Two different pairs. So yes, it's not crazy to look at two different scenarios. And the second one is this. Remember that we spoke about the New Zealand yen. One thing that we can be looking for is potential relief, right? We could be looking for price action to give us a little bit of relief, a pullback before it goes up. Well, that relief is exactly what counter trend traders are looking for. So where the relief on one pair could be something that we're waiting for to happen so that we can get involved later, the relief on this pair could be an actual trading opportunity for a counter trend trader. So let's dig into this. If we look here on the daily, price action has come to a previous level of structure. Now, make sure to check your data. Aussie New Zealand pairs have the most differences with data. But we came to a previous level of structure resistance and we held. So we did not violate. So my expectation is that we may see some relief until proven otherwise. So I'm looking for counter trend trading opportunities, which means shorts. And if we head down to the 4-hour, you can see price action holding that level of structure as well. RSI going overbought. And then a little inside bar at the top here giving us a sign of consolidation. The market is stopping and having a think right at this level of structure, which is a good sign. Now, one more time frame down to the hourly, and what we're forming here is a potential double top, right? We saw a really nice one back here in the market. This one's going to be a little bit smaller, but a double top is a classic pattern where price action rallies up. We find a level of resistance, we retrace off of it. The price takes one more shot at trying to violate that level. It loses, and then we see a reversal back to the downside. And again, here on the hourly, it's a very, very tiny one, but a potential double top nonetheless. Now, we haven't had it yet. We need to venture a little bit higher back up into this zone right here. And yes, there are very specific rules that tell you if it's a double top or not, once we haven't gotten it yet. But if we do get a valid double top, this could be a nice place to short. Now, this is also an interesting situation because of this, where on the daily and the 4-hour chart, we held that previous level of structure. You can see here on the hourly that we do not, right? This blue line was our structure high. You can see that we did have a break and close above this. And it's always an interesting conversation about how you handle this. There's not a right and a wrong reason. There's only a right and a wrong reason for you, the individual trader. And what I mean by that, kind of make this a short version, we've discussed this a lot of times on the platform, is you need to ask yourself, do I need my higher time frame and my lower time frame analysis to align? Can they be separate? Do I value one over the other? So I'll give you an example from my trading plan. For me, I cannot take this as a double top because even though this is the lower time frame or the trading time frame, we have a violation of that level of structure. And the violation of that level of structure means I have to predict a move higher. So even if the higher time frame, which is where I do my directional bias from, even if that says hold of structure, short, 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 the lower time frames have to confirm that. So if they both don't align, then they're gone. With that being said, you can easily have the rule where it says, hey, I only pay, like once I form a decision on my higher time frame, a directional bias, it doesn't matter what happens on the lower time frame, I'm sticking with it. Again, one isn't wrong, what isn't right. Eventually you got to kind of figure out what fits well for your trading philosophy. But you need to have a rule, you need to know what to do. That way you're consistent in it. Now, luckily, there may be a second chance opportunity to get involved. And this is where we have a really cool strategy called the 2618. So what I would need to wait for is 1, double top to form. 2, price action to move off that double top and violate the lows here. 3, price action to retrace back into that previous double top. And then I can look to get involved on this secondary attempt. So even if the first opportunity isn't there for you, there may be multiple opportunities here to take advantage of this on the New Zealand dollar. Staying with the counter trend theme, and I guess unintentionally staying with the New Zealand dollar as well, we have another counter trend trading opportunity here on the pound New Zealand, right? Big red candles to end the week, last 3 days, coming right into a major level of structure. This has hold and relief written all over it, meaning that this is a very high momentum move. At some point, there's going to be some relief, meaning that at some point, all of these sellers that are up here are going to say, hey, we need to start taking some money out because we've had a nice little run from $2.30 all the way down. And then those sellers, that's the wrong emoji I was supposed to use, sorry. Those sellers are going to look to cash out. And if you want to exit your selling position, what do you need to do? You need to buy. And coincidentally, a previous level of structure support is the same level that the buyers are interested in as well, right? Hence what happened back here. So you have sellers that are looking to buy to get out of their position and make the money, baby. You have buyers that are looking to buy because it's a cool level. you can see the difference between, or the shift in the balance of the selling pressure versus the buying pressure. So I love moves like this because you see those imbalances shift pretty quickly, and it opens up some really good counter trend trading opportunities. So keep an eye out on this level right here. Broken record alert, as I mentioned earlier, you don't just want to put a limit order there and buy right away. You want to look for price action to give you a reason to reverse, and then look for an opportunity to trade it up. Again, what I like about this opportunity is because it was pretty much a straight move down, it gives us a pretty clear profit level on the way up. So sometimes these things kind of ebb and flow, and it makes it really hard to project where a price is likely to go. This one's pretty straightforward back up to this level right here. So cool opportunities at a 382 as well. It's a little bit too early, but I think it is. Again, random McKeel thoughts. Ooh, not quite. A little bit below that 382. Anyway, cool opportunity. All right, last New Zealand pair. I promise, then we'll get to stuff like gold. But this is the Aussie New Zealand on the daily, and we have an advanced pattern formation forming and looking like it's near completion. This is going to be a Cypher pattern, right? One of our advanced pattern formations. And this is going to be our starting point right down here. So in a Cypher pattern, all these advanced patterns, harmonic patterns, Fibonacci-based patterns, however you want to define them, we're looking for pretty much a 5-point move. Point 1 is going to be our initial swing low to swing high. In this case, we're going to call this our impulse leg or our anchor leg. This kicks things off. We then want to take a Fibonacci retracement tool from that swing low to that swing high, and we want to measure out where that first retracement comes to. Based on where that first retracement comes to, we can kind of filter out which pattern it may be or which pattern it can't be. It's all rules based, so it makes it pretty simple, right? If I insert the old school photo of one of my first trading desks, you can see, if you look very, very closely on the back wall behind those weird looking monitors, that's actually a checklist for patterns. One of them is, at least. And I literally used to just look at the wall behind my computer and be like, all right, step 1, measure this. And I would check it off. Boom. Step 2, measure that. And I would check it off. And I'd waste an insane amount of paper, but it was very, very easy to trade. It kept me on task. And that's why myself and so many traders that I work with flock to advanced patterns, because, well, until they get the experience to feel comfortable and confident dissecting the market from more of a discretionary perspective, they need something that is kind of very strict, black and white for the most part, that they can follow until they get to that comfort level. And patterns happen to be that, because it either hits a certain level or it doesn't hit a certain level. And if it doesn't, it's invalid. If it does, it's invalid. It is valid, and you can't really argue with it. So anyway, knowing that we extend further, I know this is going to be a Cypher pattern. So now I'm looking for the next move, which is going to be my C leg. I'll mark these all out for you. This is going to be my X leg. This is going to be my A leg. This is going to be my B leg, and this is going to be my C leg. I need my C leg to come to a 127 Fibonacci extension to have a valid Cypher pattern. So let's take my Fibonacci extension tool from the swing of low to the swing of high and back down. And you can see, boom, 127 is hit. And for the completion of my Cypher pattern, I need price to return. Oh, look, it is valid already, to a 786. So the zone between my 786, which is right here, and my X leg, excuse me, which is down here, this is going to be my completion point for the pattern. And all in all, it's going to look something like this. Swing low to swing high, X to A, retracement, A to B, extension, B to C, and final pullback right here, up here, C to D for a bullish Cypher pattern. Mwah. Next is gold, and gold is fun because we have a lot of different things setting up, about probably 3 or 4 or 5 different potential setups. And originally I was going to walk you through it, but seeing how we're over a half an hour already, let's just do it and get it out the way. Now, in the previous pair, we spoke about how patterns there are rules based, but there is a small part of of discretion. That small part of discretion is going to come in the form of reading price action, reading the legs, reading the ebbs and flows. And this is why I advise all traders, but especially ones that I work with personally, don't rush through the Foundation 1 and the Foundation 2 courses, right? Those are the courses where we teach you about price action, how to read a price chart. I know it's easy to go straight to the patterns because it's easy and it allows you to start trading right away, so you think. But if you can't properly read the market, you can't properly identify patterns, then you're taking bad patterns, then you're getting bad results, and then you're getting angry, right? So baby steps. You still have to learn how to read price action first. But let me walk you through as many of these scenarios as I can see. I'm gonna 1, 2, 3, 4, 5. I'm gonna say is my final tally. 1 looks to be a potential bat pattern. So if I start with my X leg right up here and I measure this swing high to swing low, this is going to be my X to A. So it's going to give me something like this: swing high to swing low, X to A. A retracement right here coming to my 50% retracement, but not hitting my 618, which means I'm going to alert for a potential bat pattern. That's going to be my X to A, A to B. There we go. Our next retracement down here being our B to C. And if we were to go all the way back up here, we would have a decompletion for a potential bat pattern. So let's write this in. This is going to be bear bat. Oh, never mind. I can do this. Sorry, I get very distracted. How about this, guys? Bear bat. There we go. That's fun. Now, if you are a trader saying, hey, Akil, I see this as an X leg, but I really like this as an X leg better. Here's what you can do. Let's just shift things around. Let's take that Fibonacci retracement and drag it down to this. Now, this is where things change, right? Where before price, the B leg, only came to our 50%, but did not hit the 618. In this case, we do hit the 618 with our B leg, which is going to completely shift what type of pattern we're looking for. So instead of looking for a bat pattern, because we hit the 618 Fibonacci retracement, we are going to be looking for a Gartley pattern. That's going to look something like this: swing high, swing low, X to A to B right here. Let's go ahead and make this a different color so it stands out. Blue. Yeah, there we go. Our B to C leg is going to be down here, and our Gartley pattern is going to complete right at our 127 Fibonacci extension, which is right here. And the Gartley zone is going to be from here to here. So I don't have an emoji for whatever a Gartley would be, but I'm going to put a bear ghost, right? Gartley, ghost, they start with the same letter. There we go. Bear, Gartley right there. So that's pattern number 2. Pattern number 3, and again, I'm just eyeballing this. I don't know if it's actually there. If we take this as our starting point down here, our X leg, and I measure, I'm going to delete some of these fibs so I have some real estate here. If I measure a swing low to swing high up there, oh, nope, we just missed a 50%. All right, so I thought we we're going to have another bat pattern here. We do not, so boom, we can take that away. One that I do see, and I know you guys are probably shouting it as well, is a potential cipher. So let's take this as our X, right? And let's see what we have here. Fibonacci retracement, swing high to swing low. There we go. So this is going to be our X to A, our A to B right here. Again, we passed the 618, but we don't close above it, so it's valid. Know thy rules if you're going to trade thy patterns. Let's see if we have a valid C leg down here. And again, I'm measuring this out for the first time, so I have no idea if this is going to work or not. Fibonacci extension, swing high to swing low. We're looking for that 127 extension. Yep, we hit it. Now the question is, are we going to get a valid decompletion? And I need that decompletion to complete above the B leg. So this is going to be interesting. This is going to be interesting. Oh, no, it looks like, let me just do this real quick. Let me, what was the, Peter taught me the tool. Was it Shift, Peter? Nope. Let's try this again. Let's take our 786 and let's make sure we anchor it down here. And yes, look at that. So our 786 is going to complete beyond our B leg. So this would give us a valid cipher looking like this: X to A to B, B to C, and then a CD completion right up there above that B leg, just barely. So potential bull, a bearish Gartley or bat, right? Should be one or the other. Shouldn't be both, depending on how you see things. I personally see it as a Gartley, but I don't have a problem with either one. No, a bat, excuse me, the higher X leg. But I don't have a problem with either one, or a potential or a potential bear Cypher. All right, that was fun, but that's not exactly what I want to talk about at all. What I want to talk about comes on the 4-hour chart. So let's dive down there. And I guess what I want to talk about was the potential head and shoulders, right? Price action has dove down from this level right here. Turn this magnet off. We've dove down from this level right here. We found the shoulder, right? We came down for a head. It's going to be a little bit of a sloppy one. We've returned to the neckline. This could be a potential head and shoulders setting up if price pretty much put in a symmetrical move to what we saw over there. Either way, what's important about that is a violation of the neckline, meaning that if we can violate these highs, I would expect a move to the upside. All right, promise we're almost done. We're getting there. We're going to run through these pretty quickly because I think the rest are patterns, right? Canada yen, 1-hour chart, potential advanced pattern forming. Again, we've gone through these a lot already, so we don't need to measure the whole thing out. I'll just kind of shortcut them and show you. This is going to be a potential Gartley pattern looking something like this. Swing low to swing high, X to A, retracement right here, A to B, failed extension, B to C. A move down to our 127 right there is going to be our D completion. Again, for that zone going from our 127 to the low of our X leg. That is going to be a potential bullish Gartley, so a buying opportunity there. Canada Swiss here on the daily is going to be another one. This is going to be also looks like a Gartley. Let me just measure this out correctly. Yep, going to be another potential Gartley pattern. So again, we're approaching the lows right now. There may be a buying opportunity at the lows too, but if we were to violate that level, I would expect this Gartley to complete X to A to B, B to C, and a CD completion down here at the 127. Again, our zone of completion going from our 127 down to the low of our X leg. I would just be careful about stops. Make sure they should be below here if you're doing stops correctly, but I would make sure stops are below here. You don't want to be one of those cute traders where it's like, I'm going to put my stop loss, 2 pips below structure, right? And then you get stopped out and the market turns against you. You don't want to do that. Ooh, by the way, this is another nice pattern right here. Sorry, I'm getting distracted, but I see these things all over the place. Haha, boom, boom, boom. Look at that. Consolidation breeds pattern formations. And then finally, one more here on the pound Swiss. This is going to be a bat pattern. Check your data to make sure this your B leg actually hits, but this would be an X to A. Let me use the right tool. This would be an X to A, swing low to swing high, A to B. If that 50% hits, B to C, and then a CD completion right down at this 886 for a potential bullish Gartley. So that's it for this week. Type in below who you got: Arsenal, PSG, Spurs, Thunder, or I guess anything trading related as well. I love taking your questions and turning them into podcasts, but I also love sports. I'm gonna go edit this so I don't miss the final. Until next time, plan your trade your plan, and I'll see you guys Monday with the fundamental video. See ya.
I wanna be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague, we all love to hate, have to play the game, have to make a name, all our insecurities are on display.